Look, I get it. When people talk about investing, they usually go straight to stocks, real estate, even crypto. And GICs kind of sound boring, like vegetables on the side of your plate. But here's the thing. Boring is often what protects your wealth. In a world where interest rates go up, down, and sometimes feel like they're doing backflips, GICs can still play a really important part in your overall wealth plan. In this video, I'm going to walk you through what GICs actually are, why they still matter even when rates are changing, and how they fit into a broader strategy so you're not just saving, you're actually building long-term wealth. My name is James Barrie, and I'm a private wealth advisor, and I've spent over a decade helping clients grow and protect their money. I've seen low interest rates, high interest rates, and everything in between. And through all of that, GICs have never really disappeared. They've just changed where and how they fit into a good plan. So if you're asking yourself, are GICs still worth it? Or am I missing out if I use them? Stick around. By the end of this video, you'll know exactly how GICs can support your personal wealth. Let's start with the basics. A GIC stands for Guaranteed Investment Certificate. Here's the simplest way to think about it. You give your money to a bank or financial institution for a set period of time. In return, they promise to pay you back your original amount, plus some interest. That promise is guaranteed, as long as you're within the usual rules and protection limits of the institution and the product. So you're basically lending money to the bank, and the bank is saying, thank you. Here's a little extra for trusting us. There are two key parts to every GIC. First, the term. How long your money is committed for. That might be 1 year, 3 years, 5 years. Second, the rate. How much interest you earn over that term. That's it. No charts, no trading apps, no staring at the markets wondering what just happened. It's designed to be simple and predictable. Now let's talk about the big question. If interest rates are moving so much, are GICs still a good idea? Short answer is yes. But how you use them really matters. One of the biggest benefits of GICs is stability in a very noisy world. When rates move, markets move. Stocks can go up and down quickly. That can be exciting when things go your way, and stressful when they don't. GICs are something different. They give you predictability. You know exactly what you'll get back. There are no daily price swings, and your original amount is protected under the terms of the product and the institution. For a lot of people, especially those close to retirement, that stability is incredibly valuable. It can be the difference between sleeping well at night and constantly worrying about what the market will do tomorrow. Another key point is the ability to lock in when rates are attractive. When interest rates rise, GIC rates often rise too. That means you can lock in a higher rate for a set term and know exactly what you'll earn. It's a bit like seeing a really good deal on your favorite coffee and deciding, okay, I'm going to stock up now. You're taking advantage of today's rate instead of trying to guess what might happen next year. And that leads to another benefit: protection from guessing wrong. Trying to time interest rates is basically saying, I know exactly where rates are going next. Even professionals with huge research teams can't do that perfectly. With GICs, you're stepping out of the guessing game with at least a part of your money. You're saying, I don't know where rates will go, but I'm comfortable earning this guaranteed return on this amount for this period of time. That's a smart, humble approach. And in investing, humble often beats overconfident. Now, I want to put GICs in the right context because they're a tool, not the whole toolbox. Imagine your wealth as a house. The upper floors, the places where a lot of the growth happens, are things like stocks, real estate, and other growth investments. They can go up and down over a long period of time, but they're designed to help your wealth grow. The foundation of the house is safety and stability. That's where things like GICs come in. GICs help support the structure so that when markets get shaky, the whole house doesn't feel like it's falling over. You wouldn't build a house with just a foundation, but you also wouldn't build a house with no foundation at all. A good wealth plan usually has both: investments that can grow over time and investments that are steady and predictable. So, Where do GICs fit best? GICs are especially useful for short to medium-term goals, where you really can't afford to lose the money. For example, you might be planning to buy a home in the next 1 to 3 years. You might be saving for a child's tuition that you'll need soon. Or you may want a cash reserve that earns you more than a regular savings account. Or you might be retired and want stable, predictable income for part of your portfolio. In those situations, GICs can be a great match because you know when you'll need the money and you don't want that market volatility to hit you right before that moment. There's also a simple strategy called GIC laddering, and that works really well when rates are changing. A GIC ladder just means spreading your GIC across different terms instead of putting everything into one big 5-year GIC. So for example, instead of investing all your GIC money for 5 years, you might split it into 5 chunks: 1 year, 2 year, 3 year, 4 year, and a 5-year GIC. Each year, one of those GICs matures. When that happens, you can either use the money, if you need it, or reinvest it into a new 5-year GIC at the current rate. This does a few helpful things. First, it reduces the risk of locking all your money in at the wrong time. Second, it gives you regular access to part of your money every year. And third, it lets you gradually adjust to the changing interest rates instead of committing everything at once. Now, GICs are useful, but they're not perfect. And it's important to be honest about the trade-offs. First, GICs usually have lower growth potential than stocks or real estate over the long term. They're not meant to be your main growth engine for decades. Their job is safety, not maximum growth. Second, many GICs lock in your money until they mature. Some allow early redemptions, but there can be rules or penalties. And that means you don't want to put all of your emergency money into a GIC. You still want some cash that you can access immediately if life throws you a surprise. Third, there's inflation. If the cost of living is rising faster than your GIC rate, your dollars are safe, but what those dollars can buy might slowly shrink. That's why GICs usually work best along growth investments, not instead of them. GICs are one tool in the toolkit. They're excellent for safety, stability, and short to medium-term goals, but they are not designed to replace long-term investments. Let me give you a simple example of how this might look in real life. Imagine you have $500,000 invested. You might decide to keep $50,000 to $75,000 in cash and very liquid savings for emergencies. You could then put, say, $100,000 to $150,000 into a GIC ladder for the next 1 to 5 years of planned needs and for stability. And the rest could stay invested in a diversified long-term portfolio of stocks, bonds, other assets for growth. In that setup, if markets get rough, you know you have cash and GICs to rely on. If rates change, your GIC ladder allows you to adjust gradually, and your long-term investments still have room to grow your wealth over time. That's how GICs support a bigger plan instead of competing with it. Let's quickly recap. GICs are guaranteed investments where you lend your money to a financial institution for a set period of time and earn a fixed interest rate. In a changing rate environment, they still matter because they offer stability, predictability, and the ability to lock in attractive rates. They fit best with short to medium-term goals, capital preservation, and as a stabilizing part of a broader portfolio that also includes growth investments. Strategies like GIC ladders can help you deal with changing rates without having to perfectly time the market. GICs won't make your wealth plan flashy or exciting, but they can make it safer, steadier, and more intentional. And that's often what leads to real peace of mind. If you found this helpful, go ahead and tap the like button so more people can see it, and subscribe for more clear, simple videos on building and protecting your wealth. If you're wondering how much of my portfolio should be in a GIC versus other investments, that's where personal advice really matters. I'm James Barrie. I'm a private wealth advisor, and my team and I help clients build custom plans that balance safety, growth, and peace of mind. If you'd like to talk through your options, check out the link in the description and reach out. We can look at your situation, your goals, and figure out if and how GICs should play a role in your strategy. Thank you for watching, and I'll see you in the next one.